Hello everyone and welcome to another episode of our daily market analysis. Today we are going to be focusing on the gold market.
Hey there, looking forward to diving into the latest trends with you. So the first thing we are going to be looking at is the current structure of the gold market. And to start off with, I have a question for you. Given the current descending triangle pattern that we are seeing in the gold market, what do you think the descending triangle pattern indicates for gold's short-term price direction? So the descending triangle is a pattern that forms when the price of an asset creates a series of lower highs while the lows remain relatively flat. And this indicates that the sellers are becoming more aggressive while the buyers are losing their momentum.
So is this usually seen as a bullish or bearish sign?
Bearish. It's typically a bearish continuation pattern. So what that means is that after the consolidation period is over, the price is likely to continue in the direction of the prior downtrend, which in this case would be down.
You mentioned descending triangle. What are the key characteristics of a descending triangle that traders should be aware of?
So a descending triangle has a horizontal support level, which is formed by the lows that are approximately the same, and then a descending upper trend line, which is formed by connecting the lower highs.
What about volume during the formation of this pattern?
Volume tends to shrink as the pattern develops, and then once we get to the breakdown below the support, volume usually picks up, which indicates that the bears are in control, and the continuation of the downtrend is likely.
What does the descending triangle pattern reveal about the underlying psychology of gold traders?
It shows that during the formation of the descending triangle, buyers are still trying to defend a certain price, but they're losing ground with each attempt to push the price higher, which is indicated by the lower highs.
So sellers are gradually taken over?
Exactly. And the fact that the support is being tested multiple times, it creates a sense of uncertainty. Once that support breaks, it usually triggers a wave of selling and confirms that the bearish sentiment is prevailing.
So we're going to move on to the next part of our discussion,
which is key support and resistance levels. And the question I have for you is, what are the primary factors that determine where these levels are formed in the gold market? Support and resistance levels are formed by a combination of technical factors, like previous highs and lows, Fibonacci retracement levels, round numbers, and moving averages. These are all things that traders look at.
So historical price points are significant.
Absolutely. Previous areas where the price reversed or consolidated are watched by the market, as well as levels where there has been high trading volume. There's also fundamental influences, like central bank purchases, changes in interest rates, and overall market sentiment, all of which can reinforce these technical levels.
So in the case of gold, how reliable are these support and resistance levels likely to be?
Gold is known for its liquidity, and so these levels tend to be more reliable than in less liquid markets. But they're not foolproof. Sometimes the price can briefly dip below a support or shoot above a resistance.
So what should traders be watching for?
For how many times a level has held in the past, and whether it coincides with a Fibonacci level, or a round number, or a moving average. The stronger the level. But be aware of high volatility or big news events, because that can cause levels to break more frequently.
So given that support and resistance levels are such an integral part of trading gold, what are some of the ways that traders can use these levels to their advantage?
So support and resistance levels are not exact numbers. They're more of a price range, where the market has shown a lot of historical buying and selling. So by identifying these zones, traders can have a much clearer idea of where to enter a trade, where to exit a trade, and where to place a stop loss.
So how do you confirm the validity of a level?
You typically want to see a confluence of signals. So that could be a Fibonacci retracement, meeting a previous high, along with heavy trading volume, and potentially an options expiry. All of that combined will give you a much stronger indication that that level is going to hold, versus just looking at one indicator in isolation.
We're going to be looking at possible market scenarios.
So the first one I want to look at is what would need to happen for the gold market to turn bearish. So one of the key factors would be a shift in monetary policy, particularly in the US. If the Fed were to unexpectedly raise interest rates, or even signal that they're going to be more hawkish than expected, that would increase the opportunity cost of holding gold, which would be a strong headwind.
So rising real rates are bad news for gold.
Exactly.
So what would have to happen for gold to lose its bearish momentum and start consolidating or reversing to the upside?
Well, if the economic data starts to come in mixed, or if the major economies start to slow down, that could take the steam out of the bearish move, and we could start to see the market settling into a range.
So a lack of conviction from either the bulls or the bears?
Exactly. And also, if the dollar stops strengthening, and global central banks are still buyers of gold, and there's still some lingering uncertainty, plus the fact that the price has fallen to a level where it attracts some bargain hunters, all of that could set the stage for a reversal.
So what are the most important factors to keep an eye on when trying to anticipate big moves in the gold market?
Honestly, the two most important things to watch are real interest rates and the direction of the US dollar. Those two things alone explain a lot of the moves in gold.
So are we always looking at the same indicators then?
Not necessarily. Sometimes it's about the Fed and the ECB and BOJ policy divergence. Sometimes it's about geopolitical flare-ups. Sometimes it's about shifts in central bank buying, or ETF flows, or even cryptocurrency sentiment. But usually the biggest moves happen when a lot of these things are moving in the same direction. So, to sum up, whether you're a short-term trader or a longer-term investor, keeping an eye on those support and resistance levels, along with the broader market drivers, is going to be crucial for making informed decisions in the gold market. All right, so that's it for today. Thanks for tuning in, and we'll see you in the next one. Bye.